Let me tell you a secret. If your portfolio isn't performing the way you want, it's not because you're not trying hard enough or don't know what you're doing. It's because you're spread too thin. The truth is, the most successful investors don't diversify endlessly. They zero in on a few key investments and focus. Warren Buffett famously said, "Keep all your eggs in one basket, but watch that basket closely." This approach isn't just smart, it's essential. Imagine owning a few stocks that you know inside and out. Stocks that you're confident will grow and deliver returns. That's the power of focused investing. Consider Berkshire Hathaway's portfolio. The top 5 stocks make up over 80% of its total value. Until recently, Buffett owned as much as 40% weighting in Apple, deliberate strategy that has helped Warren Buffett build one of the most successful investment portfolios in history. However, this approach is best left to experts with far greater resources. The average investor should still diversify, up to 20 positions, to manage risk effectively. So if you're tired of mediocre returns and constant frustration, it's time to rethink your approach and embrace the #1 rule to building a winning portfolio: focus. The power of focused investing. Why owning fewer stocks can lead to greater success. When you focus on a smaller number of stocks, you have the opportunity to dive deep into each one. This means you can thoroughly understand the companies you're investing in, from their business models to their financial health and market position. By concentrating on a few high-conviction stocks, you can make more informed decisions and avoid the pitfalls of investing in companies you don't fully understand. Let's use Warren Buffett's investment in Apple as a prime example. Until recently, Berkshire Hathaway held about a 6% stake in Apple, valued at $174 billion. This stake once represented approximately 40% of Berkshire Hathaway total value. Buffett's deep understanding of Apple's business model, leadership, and growth prospects allowed him to make a substantial investment with high confidence. This level of concentration enabled Buffett to benefit significantly from Apple's success, demonstrating how focusing on fewer stocks can lead to remarkable results. How legendary investors built their wealth through focused portfolios. Legendary investors like Warren Buffett, Charlie Munger, and Phil Fisher have consistently shown the power of a focused investment strategy. Buffett and Munger's approach with Berkshire Hathaway involves investing heavily in a few companies they believe in and understand deeply. This method allows them to concentrate their resources and expertise on those investments, leading to substantial returns. Phil Fisher, another prominent investor, followed a similar strategy. Fisher preferred to invest in a smaller number of outstanding companies rather than spreading his investments across many average businesses. His portfolios typically included fewer than 10 companies, with a significant portion of his capital allocated to just a few. This approach allowed Fisher to monitor his investments closely and capitalize on their growth, reinforcing the benefits of focused investing. The importance of high cash flow and durable competitive advantage. The focus should be on companies that generate high levels of cash flow and have a durable competitive advantage. High cash flow ensures that a company can sustain its operations, invest in growth, and return value to shareholders. A durable competitive advantage means the company has a strong position in its industry that protects it from competitors. For instance, Coca-Cola's global brand recognition and distribution network provide it with a competitive edge that has stood the test of time. The problem with over-diversification, the myth that more stocks equal less risk. Many investors are taught that diversification is the key to reducing risk. The idea is that by owning a wide range of stocks, you spread your risk across different companies and sectors, thereby protecting your portfolio from significant losses. However, this isn't always the case. Over-diversification can lead to what's known as portfolio bloat. When you own too many stocks, the performance of each individual stock has a minimal impact on your overall portfolio. Instead of benefiting from the potential upside of a few companies generating high returns, your returns become an average of many investments, which can limit your overall gains. How over-diversification dilutes your potential returns. Let's say you've identified a few stocks with strong fundamentals, durable competitive advantages, and high earnings potential. If you allocate only a small portion of your portfolio to these stocks while spreading the rest across many other investments, you're not fully capitalizing on their potential. Over-diversification also makes it challenging to manage and monitor your investments effectively. With a large number of stocks in your portfolio, it becomes difficult to stay informed about each company's performance and make timely adjustments. This lack of focus can lead to missed opportunities and suboptimal returns. To illustrate, consider a portfolio with 30 stocks. If only 5 of those stocks are performing exceptionally well, their impact on the overall portfolio is diluted by the remaining 25 stocks. Instead of reaping the rewards of those high-performing stocks, their potential is watered down by the many other investments that aren't contributing significantly to your returns. Case studies of successful focused portfolios. Berkshire Hathaway's concentrated approach. Berkshire Hathaway's investment strategy serves as a prime example of the benefits of concentration. The company's portfolio is heavily concentrated in a few key investments, such as Apple, Bank of America, and Coca-Cola. Until recently, these stocks represent a significant portion of Berkshire Hathaway's total value, allowing the company to benefit from high cash flows that generated increased shareholder value. Warren Buffett's investment in Apple is a notable case. By focusing a large portion of Berkshire Hathaway's capital on Apple, Buffett was able to leverage the company's excellent financial performance. This concentration strategy has contributed to Berkshire Hathaway's impressive returns and solidified Buffett's reputation as one of the most successful investors of all time. Real examples. Top 5 stocks making up the majority of a portfolio's value. A focused portfolio demonstrates its power when the top 5 stocks make up a significant portion of its total value. By allocating a large part of the portfolio to a few high-conviction stocks, investors can achieve greater returns. For instance, in many successful portfolios, top-performing stocks like Apple, Google, and Microsoft often drive a substantial portion of the overall value. Concentrating investments in these high-performing stocks allows the portfolio to benefit significantly from their success, highlighting the advantages of a focused approach. The psychology behind focus. Why investors feel compelled to diversify. The tendency to diversify stems from a natural fear of risk and uncertainty. Investors often worry that putting all their money into a single stock or a few stocks could lead to significant losses if those investments perform poorly. This fear can lead to spreading investments across many different stocks to mitigate perceived risk. Another factor influencing diversification is the fear of missing out. FOMO. Investors might feel compelled to invest in a wide range of stocks to avoid missing out on potential gains from various sectors or industries. This mindset can lead to over-diversification and a lack of focus on the most promising opportunities. How to overcome the fear of missing out and stay focused. Overcoming the fear of missing out requires a shift in mindset. Instead of focusing on owning a broad array of stocks, concentrate on identifying and investing in high-quality opportunities. Conduct thorough research and build confidence in your investment choices. By focusing on a few high-conviction stocks, you can manage risk more effectively and potentially achieve better returns. It's also helpful to remember that successful investing often involves taking a long-term perspective. While it's natural to be concerned about short-term fluctuations, focusing on a few well-researched stocks can lead to more significant rewards over time. Embrace the principle of concentration and trust in your investment choices. Building a focused portfolio. The importance of deep research and high convictions. Building a focused portfolio requires in-depth research and a high level of conviction in your selected stocks. This means thoroughly analyzing each company's financial performance, growth prospects, and competitive position. It's crucial to understand not only the company's current performance, but also the durability of its competitive advantage and the potential to consistently generate high earnings. Deep research involves examining financial statements, evaluating management teams, and assessing industry trends. It's crucial to understand not only the company's current performance, but also its durability of competitive advantage and potential to consistently generate high earnings. High conviction means being confident in your investment choices and sticking with them even during market fluctuations. How to choose the right stocks for a concentrated portfolio. Selecting the right stocks for a concentrated portfolio involves identifying companies with strong fundamentals and growth potential. Look for stocks with a durable competitive advantage that take very little capital investment, earn high returns, continue to grow, and require very little incremental capital. Consider focusing on sectors or industries where you have expertise or knowledge. This can help you make more informed decisions and build confidence in your investment choices. Additionally, ensure that the stocks you select align with your investment strategy and risk tolerance. Managing risk in a concentrated portfolio. Understanding and mitigating the risks associated with focused investing. Concentrated investing involves risks, as focusing on a few stocks means that poor performance in one or more of these stocks can significantly impact your portfolio. To manage these risks, it's essential to conduct thorough research and maintain a high level of confidence in your investment choices. For most investors, a diversified portfolio, though not overly so, is ideal. Having no greater than 20 positions can help manage risk effectively. Mitigate risks by diversifying within your concentrated portfolio. For example, you can include stocks from different sectors or industries to reduce the impact of poor performance in any single sector. Additionally, regularly review and rebalance your portfolio to ensure it remains aligned with your investment goals. Strategies for maintaining balance and long-term success. To maintain balance and long-term success, stay informed about market trends and company performance. Monitor your investments closely and be prepared to adjust your portfolio if necessary. Regularly reviewing your portfolio allows you to identify any changes in a company's fundamentals or competitive position and make informed decisions about whether to hold, buy more, or sell. It's also important to have a disciplined approach to investing. Avoid making emotional decisions based on short-term market fluctuations. Stick to your research and investment strategy and focus on the long-term potential of your high-conviction stocks. By doing so, you can manage risks effectively while aiming for higher returns through a concentrated approach. Common pitfalls to avoid. Mistakes investors make when trying to focus their portfolios. Even though a focused investment strategy can be highly effective, there are common pitfalls that investors should be aware of to avoid making costly mistakes. Overconfidence. Believing too strongly in your stock picks can lead to risky behavior. It's crucial to maintain a level of skepticism and regularly review your investment thesis. Neglecting diversification within focus. While focusing on a few stocks, some level of diversification within those stocks is still important. Don't put all your money into stocks from the same industry, as this can expose your portfolio to sector-specific risks. Ignoring changing market conditions. The market is dynamic, and companies can face unforeseen challenges. Stay updated on market conditions and be willing to adjust your portfolio if significant changes occur. Stay updated on market conditions, especially if you're trying to replicate strategies used by expert investors like Warren Buffett. As a side note, Buffett has recently sold off large positions in both Apple and Bank of America, indicating changes in his strategy. If you reference Buffett's past portfolio concentration, note that these positions have since been reduced. Failure to rebalance. Regularly review and rebalance your portfolio to ensure it remains aligned with your investment goals. Failing to do so can lead to an imbalanced portfolio that may not perform as expected. By being aware of these pitfalls and actively working to avoid them, you can enhance the effectiveness of your focused investment strategy and achieve better long-term results. Conclusion: embrace the power of focused investing for better results. The number one rule to building a winning portfolio is clear: focus. By concentrating your investments on a few high-conviction stocks, you can take advantage of their growth potential and achieve higher returns. However, this approach is most effectively executed by experienced investors with significant resources. For the average investor, a balanced approach that includes some level of diversification is recommended to manage risk. The success stories of legendary investors like Warren Buffett and Phil Fisher demonstrate the power of focused investing. By learning from their strategies and applying the principles of concentration, you can position yourself for long-term success and build a portfolio that delivers substantial results. So, if you're ready to take your investing game to the next level, it's time to embrace the power of focus. Concentrate on a few high-quality stocks, conduct thorough research, and stay disciplined in your approach. With a focused strategy, you can unlock the potential for greater returns and build a winning portfolio that stands the test of time. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more insights on building a successful investment portfolio. Share your thoughts and experiences with focused investing in the comments below. What strategies have worked for you? Let's continue the conversation. Raise your IQ with cutting-edge info, insights, and analysis. Visit and subscribe for free at the link below.